Joining us right now to tell us if he is sticking with that view is Joe Amato. He's the president and chief investment officer of equities at Neuberger Berman. And Joe, welcome. This was a broad call by the firm, just thinking that inflation was going to be pretty sticky and that as a result, the Fed would have to hike rates. But all of the things that we've seen happen in the financial industry to this point, the banking crisis, has a lot of market players betting the opposite at this point. There's tons of turmoil, not just in equities, but also if you look at the two-year note. What do you think at this point?
Well, thanks for having me this morning. It certainly points to the challenge that the Fed has, right? Because it's got two challenges in front of it. First, the inflation issue, which you referenced, and our view has been that a number of the stickier components of inflation were going to be pretty resilient over the course of the year and probably end the year more in the 3.5 range than where market expectations have been, which is a bit more modest than that. Now, at the same time, of course, a few weeks ago, you had this financial stability issue, right? So the Fed's trying to compartmentalize these two challenges and dealing with inflation by continuing to raise rates, tighten financial conditions, but at the same time, use other tools in the toolbox to deal with the situation that, of course, we all that exploded on the scenes a couple of weeks back. Our view is that I think the Fed, for all intents and purposes, the hiking cycle is coming to an end. We think they may go one more time. If it wasn't for, of course, the Silicon Valley issues, we think the Fed would probably have been more aggressive, but clearly they need to pull back and slow that rate of tightening of financial conditions because, the market is doing it for them, right? Banks are going to pull back on lending given the situation that we're dealing with, and that's going to serve to, do some of the Fed's job for them.
Joe, the weird thing is watching equities. You're still talking about the market up today. You're talking about the S&P right around the 4,000 level where it's been bouncing around. All of this bad news, everything from a banking crisis to the idea that companies are not going to be able to meet earnings expectations, has that all already been priced in?
It's pretty amazing. I mean, if you think about where we are today, we're about at the end of the quarter and stocks are up 3.5%, 4%, whatever. The fixed income markets, bonds are essentially up 3-ish%. So, it doesn't really demonstrate how volatile the quarter's been, as you said. The economy is proving to be pretty resilient, right? The consensus right now for the first quarter GDP is roughly in the 2.5 range. We're about to see first quarter earnings. Now, first quarter earnings, I think, are going to be an important determinant in terms of the next phase of where the market's going to go. Expectations right now are for first quarter to be down sort of mid-single-digit percentages. Again, not that bad, and I think that's partly why the market's up. But I think when you think about the S&P 500, it really is two components, right? There is a half a dozen or so mega cap technology companies, right? They're up strong this year. They're up 20% in aggregate or so. The rest of the market is essentially flat for this year, right? The mega caps trade at 27, 28 times earnings, and the rest of the market's at 15, 16 times earnings. So it really shows the dichotomy when you're using the S&P as a broader market gauge.
I guess my question is, would you be telling people to buy if you think the rate hike cycle is done, or like Mike Wilson has been out there saying that he thinks it's going to be the end of a bear market, but a pretty violent and painful one? Do you tell people to buy now or wait for better prices?
Well, we've been defensive. We've been underweight equities for a while. We've stayed consistent with that since early part of 22. I think the last shoe to drop, if you will, is earnings. And that's where I think the equity markets are going to be driven by. So we think the economy is going to slow. The actions of the Fed clearly have a lag effect. You now have these additional credit crunch challenges and potential risks. So the risks have increased, although, again, you're toward the end of the rate hike cycle. So, we've been advising clients to get ready. There is a point in time where you want to take more risk. It's just not there yet because we haven't seen earnings recalibrate down, which we expect over the course of the latter part of 23.